Hello, so for today we're going to be looking at Vodafone. So first of all we go to our stock info screen and type Vodafone. And you see here that it's a UK listed company on the London Stock Exchange. And over here we have these icons, so company info, price history, some charts, dividends, news, and very importantly the financial statements. So we'll start off with the overview of the company. So here is the summary information for Vodafone trading on the London Stock Exchange. We've just had some accounts released, and the company itself has been around for over 30 years. The last price closed at 78 pence, and the first unusual thing we notice here is that book value is much higher than the actual price of the share. So in theory that means someone could buy all the shares at 78 and sell the assets, make a tidy profit. So we'll have to dig into the financial statements and see what's happening there. The PE ratio is extremely low, so that means the price must be either very low or the earnings very high. And when you consider that a healthy sort of PE ratio, you'd expect something between say 14 and 16. So that's very unusual. Dividend yield is high, yet it's well covered. Looking at the growth rates, the revenue is growing very slowly, so under 2% in an inflation environment of 4 to 8%. That's not good at all over 5 years. However, the earnings growth is good, net income is good, earnings per share are growing as well as cash flow, and dividends have declined. So if now we look at that in a visual format, so starting with the price, we can see that at the beginning of 2020 it was approaching 160 pence, and just recently, as we saw before, it's 78. So basically over the course of 2.5 years the share price has halved. Um, Here in November, I believe, there were some disappointing results released, and just recently the March results were actually more positive, and you can see that the price has risen a bit here. Moving on to the revenues, we could see that in the last 5 years our annualized growth rate was about 2%, so we've gone from 37.5 to 40. You'll also notice that this is very lumpy. These are quite big drops, so it's not very consistent revenue there. Earnings growing as we saw, and also the margins. So that's both good and reflected in our growth rates. Net income, we have, that looks like a loss there. So this is the reason for the rather high figure for the income growth rate. It's gone from negative up to quite a high income just in the last financial statement. So it's actually gone from 2 to 10 billion. Something to look into there. As I said, when the PE is very low, it means the price is low and or the earnings are high. It looks like we've got both of those here. Earnings per share growing. Dividends per share have dropped, but in fact the price has dropped as well, so the actual yield has gone up. Coverage ratio, as we saw, is high, but that's covered by net income. I'd like to look at the income. Cash flow growing quite nicely there. Return on equity 18%. That looks quite good. From last year 4, and then even negative here, so that trend is looking very good. Book values increased quite a lot over the last year. ratio is not the best. It's under 1. That would be better off if it was higher, meaning that the current assets can't cover the current liabilities, so the debt's due within a year. And debt equity ratio is quite high. Above 2 is concerning, but it is a very capital intensive business. So what I might do now is just compare Vodafone to other telecoms companies. Moving on to the stock screener. So generally here we would enter the metrics that we're interested in, such as the return on capital, debt equity, the PE ratio, etc., to filter out potential investments and stocks that we're interested in. But what I'd like to do here is just to go to the telecoms, I think it's telecom services here, and if I sort it by, because we're looking at VOD, I can bring that to the top. So here we have Vodafone and some of the other telecoms, so that we can just compare them and see across the industry what good ratios are, or at least what the average ratios are within the industry. So looking here, return on invested capital. So we take Vodafone at 9%, and if we just pan down here, we can see that 9, except for Spark New Zealand doing rather well there, 9% is actually very good. And if we're just looking at, say, okay, it's comparable to Verizon, T-Mobile is actually very low. Telstra in Australia is comparable, and Comcast is low. So Airtel Africa is similar. So on that metric, Vodafone's not looking too bad. So now we look at the net profit margin of 25, and that is ahead of its peers. Debt equity ratio, now that was looking high for Vodafone at 141, but we see Verizon is much higher. In fact, T-Mobile is higher. Telstra is about the same. AT&T is much higher, and Comcast also higher, and the local peer BT also much higher. So in fact, for the industry, it looks like Vodafone's debt load is not so bad. And moving on to the interest coverage on that debt, also looking very healthy. Current ratio, as I said, below 1, but it's not the only one. Most of the telcos are in fact below 1. Payout ratio, so Vodafone is paying out 21% in dividends, which is good. Fairly safe metric would be about 50%, and over 100 is not good at all, because that means your dividend is not covered by your profits. Airtel quite low, BT also, Comcast getting quite high. So payout ratio is good. PE, again, you can see that PE of 2 really sticks out. Here we've got Verizon at 7, got 30 for Telstra. Just moving on down here, really. Comcast at 35. So I'd like to dig into that, the earnings, because that is unusually low. Dividend yield of 10 compared to much lower yields for others in the same sector, and we already know that cash flow is quite good. And in income growth. So what I like to do now that Vodafone is actually sitting quite well within its peers. So I'll just come back to the company info, and we're going to dig into the accounts a bit. So here we have, for all the companies that we cover, 20 years history. And I'm just going to start with the ratios. Here we've got a operating margin going back a few years. You can see that traditionally their margins have been actually going back very low, 6, 4, 3, 8, and then slowly rising, and very high operating margin in this last year. By the way, if you click here, you can see the basis of the calculation. So operating income divided by revenue. Return on capital, return on invested capital. Again, you can see the details here. So income on assets, basically. Again, go back a few years. Very poor return on capital, and that probably explains why the share price has been going down. Investors can just get a better return elsewhere, and they've been disappointed in the performance. But the return has jumped this year, so we're going to want to look at the inputs into this, especially net income, seeing as that it's jumped. The cost of debt, that's just to compare with the invested capital to make sure that, in fact it hasn't here, the cost is higher than the return. Again, but for this year is looking quite healthy, and as we know, a very high dividend yield. PE is all over the place, but very low in the last year. Debt equity has been trending down lately, which is good. It's high, but it's coming down, and the interest is well covered. So the only things that look a bit strange there, it keeps coming back to income. So let's have a look at the income statement. So revenue fairly steady, and growing slowly. So no surprises there. Same with cost of goods, gross profit. Everything is pretty much in line, except here we have a very large other operating expense. So we've got 8 billion there, and this is in pounds. And we see that our net income, so we've been making losses here over the years. Last year almost 2 billion, and this year 10. So that negative operating expense means that it's an income, and so you've got another 8 in there. So this is more like 2. So we need to find out what that operating expense is or income is. So I'm just going to go to the annual report. Scrolling down here, we want to get right into the financial statements. And so here, just again, scanning across the years. Okay, revenues, costs all in line. Expenses, nothing unusual there. And our operating profit is bumped up. It's 9 higher than the previous year. Other income, here we go. It's in here. And what have we got here? So what I've done is put the gain on disposal of Vantage Towers into other income. So we should really, as investors, ignore that in the sense that it's not really the core business buying and selling and booking profit on into their operating revenues. So we can come back here and say that basically our net income has been poor for many years, and in the last 2 it's sort of come up to about 2 billion. So now that we've had a good look at our numbers and got a feel for the company, and we've discovered one or two things in here, so it's time to summarize our findings and prepare the data for evaluation. So one thing that we did find is that the disposal of assets, of operations in fact, was going into the net income. So here I've taken those values across our 5 years and I've subtracted them, because you'll see not only in 2023 but also there's a large number in 2020 where they divested themselves of activities in Italy and New Zealand. So we end up with this restated income line, and so that you can see that our growth rate has dropped from 37% to about 24%, and the growth rate for earnings per share, which will be an input into one of our valuation models, has likewise dropped from 37 to about 24. One thing to note here is if I actually calculate the growth rate on the share price, and remember this is the rate that you apply every single year for 5 years, that on price the shareholders have been losing 11%. So every year you're losing 11% if you've held for the last 5 years. So that then means if we use our restated income to calculate our price earnings ratio, that mysterious 2.05 that we first saw comes up to a more credible PE of 10. And just in passing, the free cash flow here is at the moment very steady at about 10 billion. So two things that are very important are the continuing free cash flow and continuing revenues. Of course, the revenues have been quite disappointing in that they've been trending down, which is a large part of the reason for the disappointing share price. I also think alongside expectations over the last couple of years of mergers, of activist investors trying to increase the returns from Vodafone and being disappointed. So all that added together has led to a share decrease. But cash flows are good. Vodafone has just released a Q1, so that is April to June 2023 trading update. Core revenue is up 3%, 3.7% versus the previous quarter of 2%, so that's very encouraging. One thing that was a worry was that Vodafone is losing revenues and I assume market share in Germany, which is a key market. So in Q4, so that's Q1 23, they were down 2.8%, but in this latest quarter they are down 1.3%. So hopefully they are starting to stem the tide on that, and the revenues, we are hoping, will start growing at a bit of a faster pace. So with these figures in mind, we'll come back to the website and the valuation tools. We have two flavors of these: standalone, whereby you enter your own figures, and integrated, where it's integrated with the company financials. So coming to the Graham formula first, we'll just bring up Vodafone and calculate. Scroll down, and here's our Graham formula calculation. And it's pulled in the numbers from our latest financials. You'll see here our original earnings per share, so per the spreadsheet, that is now 0.09. Our earnings per share growth rate is 23.79. I'll leave the PE there and the growth modifier. The risk-free rate is based on the government bond yield. So if you see here, it's a British-based company. So if we come to data, we have our risk-free rates, and we're going to have a quick look at that, see how current it is. So UK, and updated on the very recently, we have a bond yield of 4.3%. So that is our risk-free rate, because we could just take our cash, our money, and invest it in government bonds and get a return of 4.28. Likewise, inflation rate of about 8%. So again, coming to data, we have our inflation rates here. And for the United Kingdom, latest inflation figures are as of April. Just bring up that chart, and you can see here that in the UK, inflation has peaked here, just under 10%, and it's coming down, so 7.8%. So coming back to our formula, the logic behind this is that I want to know what I could do with my money risk-free and what my return would be, and I want at least that. Plus, in this very high inflation rate environment, I also want to stay ahead of inflation. Then we come to our risk premium. So on top of the risk-free rate, inflation rate, I want to be rewarded for the risk that I'm taking investing in this particular equity. So I'm just going to increase that to 10%. And there is the investor's required return to hold that stock. We've got the latest price here and a margin of safety. Now, for all the analysis that I've done in the preceding few minutes, it is quite superficial. All of those ratios, all of those numbers, we could dig into far deeper. Secondly, we are projecting into the future here based on past results. So the margin of safety is sort of well, that's it, it's a margin to say, well, there may be mistakes, there may be things we haven't covered, there may be things that we haven't seen. So if adding all of that together, we actually get an intrinsic value of 0.81, which is very close, in fact, to the latest price. So given my risk profile, the price is actually where it should be. So next we're going to go to our discounted cash flow model. So Vodafone, calculate, and here we have it, valuation based upon the discounted cash flow method. So we're taking our cash flow growth rate of 11%, we are projecting that forward 5 years. We have the same risk-free and inflation rates we had before. I'll enter the same risk premium and the same margin of safety, and you'll see here that the latest price again is 78, and we have an intrinsic value based on cash flow of 3, which is quite an amount of upside. However, the last 4 years, I see that the cash flows have been very steady at about 10 billion, and before that they were just over 6, which leads to this cash flow growth rate. However, if it carries on at 10 billion and we assume the cash flows stay static, I would much prefer to adjust that, which leads us to an adjusted intrinsic value of 1.38. Now, if I average out the Graham formula value of 81, the discounted cash flow of 138, then I come up with an intrinsic value of £1.09 compared to the current 0.78. So it's not a bad upside there. Putting that all together, what have we got? A global player on in the telecoms market at a press share price, a company which has a great brand name, a new CEO. It is sitting in very comfortably with its peers. The intrinsic value appears to be above where it is at the moment. The cash flows are good. The only problem is that revenues have been decreasing, not increasing. However, the current quarter is looking better. So all in all, it appears that Vodafone is a bit of a turnaround play. Let's hope that the new CEO is able to do something with this. And well, this is not, of course, investment advice. As I said before, you could go a lot further in the investigations. But if you like what I've done here and you want to use this as a basis for your own investigations, then come along to growthwithvalue.com and you can use all the same tools that you've seen me use here. Thank you.